So now the deal may not work.
Correct, right? It doesn't work, but you're already under construction. You know, we have the technical term of you're already pregnant. You got to finish the project, right? Regardless. So certainly your costs are, and then not to mention the fact all the supply chain issues and all the stuff that was going on during that period of time. All of that stuff matters. And then of course, when you're done, that's when you start to lease up. So all of that stuff is extremely important. So when we're looking at the market today, we're looking at all those factors. I personally want a market that's overflooded with the supply, that has a lot of interest and a lot of population growth. That's actually what I want. I want a disruption with a new build or an existing project with maybe a bad loan, that in a market that a lot of people want to be in. That's what I want. The question is how long do I want to sustain the pain after buying it, right? And how long do I have to give away concessions, and how long will it take to stabilize? In our world, it's called absorption. So how long does it take that property to absorb and stabilize? And stabilized for me means 92% occupancy. So that's kind of the goal. We just finished a 300-unit project in Tucson. When you start it, you have 300 vacancies. Like, think of that. 300 vacancies. So I'm very used to filling vacancies. That is the game. I have it on my existing properties. We have almost 10,000 units, but on the new ones, they're 100% vacant the minute you open. We're very used to filling units, attracting tenants, and managing, a lease up or even vacancy. For me to take over a project that's 75 or 80% occupied, or let's call it 25% or 20% or even 30% vacant, I have no problem with that. I just got to fix it, figure out how much money it's going to take
to get there.
And I bought a lot of stuff like this in 2008, 9, and 10, 11. We bought a property in San Antonio, 680 units. It was 50% vacant, owned by a bank. So you negotiate with the bank, and I put a bunch of money on the side. It's called interest reserves. And then I knew that I was going to have to spend a bunch of money on the capital work, the parking lots and the roofs and the interiors and all that stuff. So you basically budget all those things, and then you deploy your team to fix all that. And then it's really a race of occupancy. How quickly can I get this property occupied? The secret to that really is quite simple. It's 50% vacant in a market that's 92, 93, 94%. So you have a failing asset in a really good market.
It's the asset's fault.
Yes, it's the asset, it's the management. Yeah. So you're fixing it for the lender and obviously for your investors.
You mentioned there is a significant amount of supply in the multifamily. Is this going to spill into the single family, or does it not? The multifamily business, the tenants and the way it works is completely different from the single family.
Yeah, it can. If you're a single family landlord, then for sure you could be competing with a new apartment community nearby, because the apartment community could win, but it might not. So if you have a family and you want a garage and you need a yard, you're going to win as a single family. But if you don't, and you've got the apartment community with, let's say, this beautiful exercise facility area, beautiful pool, has all these community things that you can do, then you might want to move into that, where you have more of a community. So, but it definitely can spill over to that. But I do not think at all it will compete with just a single family owner.
Ken, with all of your experience and what you're seeing right now, do you have any recommendations for investors right now?
If you look at what happened in the last few years, a lot of investors jumped in, and they're gun shy, and they should be. The big issue here is, if you buy, you need to buy with somebody who's seasoned. If you're investing, let's say you're just investing yourself, or you're investing in somebody else's deal, you want to really question the business plan, the methodology, the assumptions, the underwriting, all of those things, and really, really, really do that, because that's actually what got everybody in trouble before. And I'll give you a quick story. Ross, my partner, and I, we decided to sell one property in Houston, Texas. And before we decided to sell it, we renovated 4 units to see if I could push the rents any, you know what I mean? Because the property wasn't that tired. It was built in like 2010, But we said, let's put some granite countertops in here and paint it and see if we can at least get 50, 60, 70, maybe $100 more per. So we did that. First, we couldn't get it. Like we tried, but the market's the market. I mean, the renters tell us what the market is. The landlord does not drive rents. The market drives rent. So anyway, okay, there's no more meat on the bone. Let's sell this. We have a lot of equity in it. Let somebody else buy this. We listed it, and I happened to be on the list of the person who put it in escrow. So now I'm the seller, and they're the buyer, and I get their business plan on my project that I own. So you can imagine, so I open the project, and what does it say? Horrible management, lots of rent upside, this is we're going to reposition this, and had all this stuff that I already tried. Now we're in escrow, and they're asking me to invest, and I sent it to my partner Ross. I go, check this out. This is pretty interesting. And now it's possible that happened for them, but I'm just saying, the point of the story is you can put anything you want in a business plan, anything. But to be able to back it up and ask the good questions, that's what an LP or an investor needs to ask, is really the rent assumptions, the expense assumptions. If somebody in this market right today is saying, we're going to have massive rent growth, you need to run. Because I personally, for the next 24 months, have said no rent growth. It needs cash flow today. If somebody in this market is saying, we're going to slash expenses, run, because expenses are not going down. So, there's little things there's nuances, and I guarantee you there's going to be business plans out this year that say, we're going to have 10, 12% rent growth, we're going to slash expenses, we're going to do this, we're going to do that, we're going to value add, and there's no value add options right now. Like this is not the time to value add. What you're trying to buy today is real estate that cash flows as it is today, with the existing tenants, existing rents, and existing mortgage. And then from there, you have those options later when the market's better. But if you have to make the deal based on next year being better than this year, then they should pass.
Ken McElroy, it was great to have you on Marketing Insider.
Thank you very much.
Let us know what you think about this conversation with Ken. Do you agree?